Welcome to the True Wealth Investors Real Estate Podcast. Creative investing strategies to help you build true wealth. I'm your host, Chad Harris. All right, welcome back, everybody. Glad to have you, as always, on True Wealth Investors Real Estate Podcast. I am Chad Harris, and one of the things I talk about a lot is that to get ahead in our business and to grow, we need to be around other people who are further along than we are. And that could be a local meetup, that could be books that you're reading, that could be RIA, a mastermind you join, a coach you hire. But I also truly believe that that's a large purpose of this podcast. And so today is one of those days where we have somebody who's been successful in real estate and wanted to have him on to share his story so that you guys can benefit from his experience. And also, he's got a unique twist on what he's doing now, where he's kind of transitioned from real estate to lending. And I'm looking forward to hearing more about that transition. So today we have Rich Lennon. So thank you, Rich. Welcome.
Thank you, Chad. And I really appreciate the opportunity to be here. And I couldn't agree more with what you said. I have benefited greatly from going and being around other people and listening to podcasts such as yourself to get myself educated. It is certainly crucial to success.
Yeah, thank you. There's so much that can be gained from that. And I was always a big reader. And then once I hired my first coach, that was a jump for me. And I wondered why I hadn't done it sooner. Like,
Yes,
it was
yes.
so beneficial to benefit from all of their experience. And but the podcasts are a real easy way to learn from a lot of different people. So yeah, thanks again for coming on to share your story. So you are out of Richmond, Virginia.
Yeah, Richmond, Virginia. That's right.
Okay. And fill us in on your background before we get into what you do right now. How'd you get into real
Yeah,
estate?
sure.
What was that journey like?
Yeah, well, I was living in the DC area for a long time, 30 years. I went to college, but 30 years I lived there. And my wife came to me one day and she said, "Hey, Rich, we're going to move to Richmond." And I was like, "Okay, we're going to move to Richmond." And she said, one of the things that, because she knew I was getting into real estate in the DC area, and she pointed out correctly that the median sales price of a home in Richmond was such that you could cash flow. And so she kind of used real estate to leverage me into agreeing to move to Richmond. And we did that around 2010. And by 2011, I was buying as much as I could. And for me, that was 4 to 5 homes a month. I was investor full time for about 10 years until 2020, where I kind of reached the point where I stepped aside from it. But I did that for a long time. And yeah, it was fantastic. I sold about half of them and I kept about half of them.
Were you okay? So you were buying 4 or 5 a month, kept half of them. That's
Yep.
awesome.
Yeah, that was a good decision.
Yeah. Were you flipping or wholesaling or what were you
Mostly
doing?
flipping.
Yeah.
I did, of course, if you're doing that kind of volume, every once in a while you wholesale, but that was certainly not my focus. I wanted to keep all the profits I could, and for me, that avenue was flipping, and the delayed gratification is exactly that. It took a while. Of course, the wholesale gets paid immediately, but wait 6 to 8 months and you get a bigger paycheck. And once that machine kind of starts going, it's important to maintain it and get the maximum value you can out of those leads.
Okay, sure. So for some context there, 2010, your wife convinces you to move to Virginia.
That's a
Where
nice word. Told is another way to say,
or coerces you or gave a great sales pitch. I don't know what how you would frame that. What stage of life were you in then?
I
Um,
was in my mid 30s and I had my wife and I didn't get married till a little bit later in life, but we've known each other since high school. So we were, lifelong friends. And so I was an entrepreneur before that. By education, I'm an engineer. So I went to Virginia Tech. I got engineering degrees and was in that business for a brief period of time. And although my brain is built for an engineer. I'm very logical, very math oriented. It certainly wasn't a passion. And literally, I was in a nuclear reactor one day for General Electric, and I looked around and I'm like, I do not want to spend my life in a nuclear reactor. Literally, like a Homer Simpson nuclear reactor kind of thing. And yeah, so I've been a serial entrepreneur my most of my adult life, and really took to real estate in 2011.
Sure. Were you and your wife looking at getting into real estate already, or what brought on that transition, or looking at numbers in Virginia?
We had been accidental landlords, and we bought property in the DC area. We lived there, and then we moved to the next property, and we didn't have to sell it, so we kept it, and so we rented it out, and that's what I mean by an accidental landlord. And so
Okay.
we understood some of the power of it. I also had an uncle who had accumulated a modest 10 to 20 homes over his career, so we had a little bit of background on it. And I was looking for something to do. My wife is very much the W-2 person. She doesn't work anymore, but she was very motivated, very successful at that W-2. And so she actually kind of thought I was crazy for doing the real estate thing. I think it's fair to say that she wasn't on board with it. It took some time, but I think looking back, I know she's grateful that we did it.
Sure. So, all right. So I mean, anybody who is listening to this story, there have to be some questions that come up, where you move to a new area, you're very quickly buying 4 to 5 houses a month and holding half of them. I mean, one, how are you sourcing these houses? Two, how are you funding the houses?
It was a
That's a
process.
large scale for both of those, really.
Well, I started in 2011. I wouldn't say that I was really buying that many houses until maybe 2013, right? It took me a couple of years I went with the idea I was going to buy one a year, and then it was like twice a year, and then one a quarter, and one a month, and then one a week, because I kind of went through that stage.
Okay.
Um, I was a, I was a direct mail guy, and I mean, that was in the back of the day of, yellow,
Yellow letters dot
yellow
com.
letters. Thank you. Yellow letters
Yeah.
was, I mean, that really dates me, but it was the yellow letters.
Yeah.
And I spent, I mean, like $10,000 a month, which was a lot back then, on my marketing. And we did mailers because I wasn't good at the other forms of lead generation. I'm a Gen Xer. I got a bunch of gray hair, so texting's not really my thing. Um, I'm also a one man show. I have a bunch of VAs, but in locally, I'm a one man show, which meant that I'm out on an appointment or I'm looking at a job site, so I couldn't answer the phone right away. And so like pay per click and things like that, where you have to be very responsive. And these were the days before all the education. Like the internet really wasn't as powerful then as it is now. And we entrepreneurs, we kind of had to learn it on our own. And I was very much a lone wolf for a long time.
Okay. And was there a target market? Not, I mean, I know your region, but was there a certain customer you were sending that direct mail to? Or were
Well,
you
by the time we
in
got to the full,
foreclosure, or some other distress?
yeah, so we would send out about 20,000 mailers a month. And so we certainly had a very broad categories that we would send to. I will tell you that by far the most profitable ones were always the pre-foreclosure market. I was in that pretty heavily. I would say that was a statistically significant part of my business was the pre-foreclosures. And of course, tax sales as well. At the beginning, like 2011 through like 14 or so, you could buy houses on the courthouse steps at a reasonable price still. So you can't really do that now. They're just bid up so much and overvalued. It's hard to do that. But yeah, I mean, I was my goal, and it was a foolish goal, and I'll tell you, I never achieved it. But I always wanted to buy 10 per month. Like that was just my mental. I chose that number. I don't know why I chose it. It wasn't a good decision. I should have like chosen something of like profit or happiness or so. It certainly caused some issues along the way, but so I was always kind of expanding that region, but I did early on decide that I wanted to only buy things that I could go and touch and feel. And so I did try to venture outside my market a couple times, but I made mistakes and it cost me money. And ultimately, I decided to stay very local. So within an hour to an hour and a half, the center of Richmond, Virginia is kind
Okay.
of my ground.
Yeah, what is it about entrepreneurs that always get sucked into the big numbers,
Yeah, I
and not
know, right?
necessarily the result, because your time freedom and 10 houses per month are, I'm guessing, opposed to each other. You're gonna have
Oh
to work a
yeah.
lot.
At the
Um,
beginning, it was certainly 60, 70, 80 hours a week. You get into owning your business for freedom, but if you want to be successful, there's not a lot of freedom at the beginning.
that's for sure. Yeah.
And
It's
I,
while
y-
in the long run, and that freedom comes down the road.
and something you mentioned at the beginning that maybe is pertinent to this is I like you, I've gotten coaches along the way. I didn't get them as soon as I should have in my career, but I finally did. And I joined networking groups as well. And it was a gentleman, his name is Glenn. I won't say his last name, but we were telling our stories to, like, you're sitting around a table, you're in a networking group, and there's 10 people, and you just say, "Oh, my name is Rich Lennon, and I'm trying to buy 10 houses a month." And Glenn, who was an older gentleman sitting next to me, under his breath, he's like, "That's the stupidest thing I've ever heard." And and I was so offended. But by the end of it, Glenn and I became friends, and he was correct. That was a stupid goal. My goal should have been much better defined. And of course, because I was chasing a goal that wasn't well defined, I was making mistakes. But his little offhanded comment really set me in a different direction, and it would not have been possible without that network.
Those wake up calls. Was there
Yeah,
something, so not to dwell on the topic, but was there something
good.
you had in mind that 10 houses a month would bring you a certain thing? Or was it
Yeah.
just that, okay, go ahead.
Well, this is embarrassing. Some other guy in one of those networking groups stood up and said he was buying 10 houses in a month. And I looked at him and I'm like, dude, I'm better than you. And I was
Yeah.
like, and I
That
was
is so
like,
easy to do, or so easy to fall into that. I fall
I was
into
like, if
that
you can
too.
do it, I can do it. And
Yeah.
unfortunately, that was as well thought out as that plan was. And but I mean, I have no regrets. I mean, I enjoyed what I did for a long period of time. I was very passionate about it. But yeah, we as entrepreneurs, we just set arbitrary goals sometimes, and they don't really
Yeah.
make a lot of sense in retrospect.
Yeah. Okay, so how were you we've got the finding. How were you funding those deals?
All private money. So
Awesome.
I was very passionate about what I was doing, and I would just kind of talk about it. And certainly that ostracized some of my friends. Some of my friends were like, "Rich, just shut up. I don't want to hear any more about this stupid thing." But it attracted other people as well. And my first private money came from a fire pit where we were talking about they're going to increase the real estate taxes in the county. And I was sitting around with just a bunch of homeowners. Nobody was a real estate investor, just a bunch of homeowners. It was around a fire pit. And someone was complaining about the taxes going up. And I was like, well, I own like 15 or 20 homes in this county. I think that tax is really important because we need to upkeep a bunch of stuff and schools. And I was kind of making that contrarian argument. And the next morning, I got an email from a lady who never participated in the conversation. And she said, "Hey, I've got a bunch of money lying around. Would you consider using my money for some of your real estate transactions?" And that was my first private money lender. And I still borrow their money till today. Wow, it's got to be
Yeah,
almost 15 years later.
that's sharp.
So, yeah. And another one was I was at a bouncy house at a kid's, like, at my kindergartner's birthday party. And like every other parent who has a child at one of those bouncy houses, you're like, I don't want it to float away. So I was like standing next to it. So my kid doesn't break their neck or they don't float away. And of course, another dad was doing the same thing. And we were just awkwardly standing there. And he was like, well, what do you do? And I just started to talk to him about it. And he became very engaged with me. And he ended up being a big private money lender as well. So my private money lenders came from non-real estate people that I just kind of told what I was doing. And yeah, that's how I built that network.
That's sharp. Yeah, that's your story is really similar to my story raising
Yeah.
my
Yeah,
I
I
just
think a lot of people do it that way. Yeah.
yeah, you just get your story out there and what you're doing, and naturally we're kind of passionate people, and you know, give off that excitement, and people want to be in real estate, but a lot of times they don't know how.
That's
So
exactly right.
one of my early lenders, I was thinking back recently, he was wanting to buy a rental property, asked me to give him some advice on how to run the numbers. And we ran the numbers, and I said, it looks like you'll make about 10% on your money. And he's like, oh, well, that's pretty good. And I said, really? You're comfortable with 10%? I said, how about you just give me your money and I'll pay you the 10%. You don't have to deal with the real estate or the tenants or any of that. And that was the sales pitch, there was
Yeah.
no sale. It was much easier for him. So,
I think people are self-identify. I think people kind of, I think, get caught up in the idea that it's awkward to ask for money, but I think your money comes to you. You don't have to ask for it. You just speak about what's going on, and then they self-identify. And the people who have follow-up questions with you or sit down and go over what's going to be my return on this deal, those are the people that end up being your private money lenders.
yeah. Yeah. Yeah, I found that there's never a need for a sales pitch, or asking for money. It's finding out how my business serves their needs, and they're looking to get into real estate, or they're looking for a good rate of return without the risk of the stock market. And there's a whole bunch of things that being a lender in real estate is really beneficial for.
And there are a lot more than people suspect. There are a lot
Oh
of
yeah,
millionaire next doors, and they're either W-2 jobs that have put some money away, or maybe they own like an HVAC company that's very profitable, but they know HVACs. They don't understand the money, and now it just sits in a bank account. And you offer a very good service for that.
right. Yeah, completely.
Hmm.
So yeah, I think that's one of the biggest obstacles. I mean, I coach people on how to raise private money, but probably the biggest obstacle or perceived obstacle is that people don't believe they know the right people. I'm not in the right circles, or I'm not rubbing elbows with the right people. And I would argue that one, you most likely are, because there are
Yeah.
people with money looking for a return all over the place. And all of those people have a financial planner who's telling them it's really good to diversify their investments. So they're promoting what we do.
Yeah.
And then even if for some odd circumstance you don't know anybody like that, it's not that hard to start rubbing elbows with those people and get in those circles. So because they're
Yeah, I think that things like the Chamber of Commerce, or like you can just go down there, well, hey, what do you do? Like it's a whole all set up for people to ask what you do for a living. And
yeah,
then you can just talk about it in a very natural,
all kinds of
non-intrusive
groups
way.
out there. Yeah,
Yeah.
yeah. So sharp. Okay. So let's get into how you transitioned, because obviously you were very successful in the real estate space. Um, then you transitioned to more the lending side,
Hmm.
right? Did you uh, give up the real estate and go fully into lending, or what was that transition like, and what necessitated it?
I was burnt out. I was really burnt. I'm not necessarily even aware of it at the time. I had arbitrarily, it's one of the arbitrary goals. I'd set an arbitrary wealth goal for myself, and I had hit it in 2019. And, the banks are always asking you for your financial statements. And, one time we were doing the financial statement, and then that's the number that came out. And it was like, oh, well, that's the number that we set all those years ago. There it is. And so that was part of it. And then I was just tired. And I was like, I don't really want to be buying 4 homes a month. It's a lot of work. And running a construction company, a marketing company, a disposition company, an acquisition company. I'm doing all those things in one. And I had been building my IRAs. I do a lot of self-directed IRA investment type things. And I had been loaning money out and doing creative real estate inside my self-directed IRAs for almost a decade at that point. And I when I stopped, I had 14 employees at the time, and you can't just stop a train like that. It takes 6 to 8 months to wind down. And that was during COVID. We were winding down as COVID was kind of rolling out. So this is 2020. And the money starts to pile up in the bank, right? Because you're in all these constructions, and then you sell them, and then you have a bunch of your money in all the deals. And ultimately that money comes back, and now it's in the bank. And so I just started to lend it because it's something that I knew and understood. And then I had put all the money out by 2020. My average loan is 200,000, so you put it out a couple times, and I started to what I call fractionalizing the notes, where Now, my private money lenders who had been giving me money to flip homes at like 10%, that's pretty common. They were all mad at me because I stopped buying homes, right? Because now their
Yeah.
money wasn't moving anymore. And so it was really a product of they're like, hey, Rich, you really haven't borrowed my money in a while. It's been sitting in the bank account for 6 months, earning like at that point, it's like less than 1% interest. And so I was like, okay, for every $200,000 loan, I'll put 100,000 of Rich Lennon's money in, and then I'll put 100,000 of your money in. And I was lending the money at 20%. And so my 20% is what I get on my $100,000, and my private money gets their 10% on their 100,000. But then I also get the 10% arbitrage. And so now my $100,000 was really making 30%. And I was like, wow, this is great. And then I went into my rental portfolio because I had built up a sizable rental portfolio. And I started looking at it. I was like, oh, I'm worth all this money on paper. What's my actual growth on that wealth? And I realized that it was like 5%. It really, like, I think rentals are great at creating wealth, but they, over time, they grow it at a slower and slower rate. The more equity you have, the slower it grows. And so I started to liquidate the portfolio towards the end of 2020 and 2021, and I continue to liquidate it today. And I take that money, I take it out, and then I just start lending it out, and it's done wonders for that growth curve.
Okay. Sure. Were you self-managing the rentals or do you still?
No, no, I managed all those from the Philippines. I was probably one of the first adopters of virtual assistants, even before it became a thing. This is like 2012, maybe 2013. And
Okay.
so we have always managed the rental portfolio from the Philippines. And I just realized that I didn't personally have to go in the rental. And if I didn't have to do it, then anybody could do it. So I had people coordinate from the Philippines with the boots on the ground in Richmond. And I found that to be a very economical way to manage the portfolio.
Sharp. All right. Well, it's interesting how you transition because you're not the first lender I've met who was borrowing a lot of money from other private lenders and then slowed down their deal flow and their
Yeah,
lenders started complaining.
that's right.
Which, yeah, which when anybody starts raising money from private lenders, they feel like they're asking for money
Yeah,
incorrectly and they feel like the lender wants their money paid back right away, which isn't correct either. The
that is
lenders,
not correct.
they want a return on their money
Hmm.
and they like that continuous deal flow and return on their money.
Yeah, and when you give it back to them, they have to do more work, right?
Yeah,
They just want the money out moving, and they get annoyed every time you give it back. And I had the same type of epiphany or maturation in my thought process of, hey, I'm doing them a favor. Because I also
right.
thought originally that they were doing me a favor. And now as a lender, the people who borrow money from me, like I now service them because they are the ones that are going to go out and do the flips. They're going to want to do the bird. They're going to put all the effort in. All I have to do is make sure the documents are correct, send the wire, and that's it. And those are valuable people in my life. And I didn't realize that as a borrower for a long time.
Sure. So, okay, so bunch of questions here. When you're
Sure.
lending, one, why fractional? Why 50% from a private lender, 50% your money? Why not raise it all? Or, I mean, I know you were looking for a return on your money, but what
Yeah,
initiated that
because I for me it's growing my money. And if I don't, I could do it with someone else's money, but then I'm just like getting the points from getting a very small spread. And then now I'm in the transactional business again.
right,
And I don't want to be that. I know a lot of people sometimes when they fractionalize, they only want to put 10% of their own money or 20% of their own money. But once you get to have a lot of money, you need to now deploy your money in bigger chunks. And so I always wanted to be in at like 50% because I'm working my money. And there is the I'm working the private money as well, but the real intent is for Rich Lennon to grow his wealth.
yeah,
And so therefore I fractionalize it. And when earlier in the career, this is prior to 2020, I used to fractionalize it even more. So like on a $200,000 loan, I would put $50,000 of my money in and $150,000 of my private money in. And those types of returns are like 50%. I get 50% return on my money. But then you get a whole bunch of money and you have to do twice the amount of work to two times as many deals to get 50% return. So I'm very satisfied with 30%. And that's kind of where the business is now.
Yeah, I don't think you should be upset with 30%, Rich.
No, they're like, you can't complain about that. When I tell people that that's what I do, they just don't believe me. They're like, I don't, that's not possible. And I'm like, I don't know. I'm into these deals at 60% loan to value. Like the stock market won't give you a 60% loan to value.
Right.
And there's really a pullback in the real estate market takes a year. It doesn't take a Monday morning. And I've done hundreds of loans this way at this point, and I've never foreclosed on a property. And there are definitely some like guardrails that you have to put up to make sure that you follow. But I think if you do those things, I think it's a very secure, nothing's ever safe, but it's a very secure investment. And I just haven't seen a better product that an individual like myself could do. Maybe if I had billions of dollars and I could just, you know, do crazy things with. But uh, at a single entrepreneur level, I found it very good.
I mean, I think the returns are amazing, really. So just structure wise, what's your typical origination points and percents? How long is the loan you typically do?
Yeah. So I lend at 13% and 3 points for 6 months. And I will tell you, because I am an engineer, so I follow the data and I follow my loans closely. And even though my loan is for 6 months, I will tell you the average over those couple hundred loans are about 8.5 months. And that
Okay.
everybody always thinks that they're going to, I'll have it back to you in 6 months. I'm like, okay. And I mean, and that's more a product of government actually, because just getting permits around Richmond is very difficult, and it just takes months and months of bureaucracy even to get started on a project at times. So, um, yeah, so it stays out about 8.5 months, and I'm happy to keep it out for that long. And
And to
yeah,
extend it that second 6 months or, from the 6 to 8 months, they pay the origination points again. Is that
I
correct?
don't I don't charge the points. You could charge the points. You certainly have every right to. And the note often says that they will charge the points. But in general, I just allow the blended rate to continue.
Mm.
So 13 and 3, that's around 20% because of the points for 5 months out of the first 6 months, it's above a 20% return. And from the last month of the 6 month loan, it ends at 19% on exactly month number six, like that day. And so I just charge a per diem of 20% for however long they keep it. Because I just hate to charge a whole bunch of points and then they like pay me back a month later.
Right.
Because
Right.
I like to lend in the same way that I like to borrow. Like, don't kill me with points. Don't like have a fee every time I got to do something. Don't give me a lawyer reviewing the documents fees. I never wanted that stuff. And so I kind of built my model around that. And I think repeat customers come back for that reason.
Right. Your biggest struggle, I would think, would be deal flow if you're burning your clients with points and fees,
Yes.
things like that, and trying to find new lenders. But if you have successful lenders who are happy with the terms and working with you, I mean that, and you have lenders constantly wanting to give you money to fund the deal with your money. I mean, that sounds like a great business model.
It's
So,
worked out. It really has. It's worked out very well. And I do think that your point is very accurate in that new lenders will often charge those penalties and points. And then if you're lending a small amount of cash, maybe, and it's not a small amount, but if you're doing one loan of 200,000, you can go find another client. But in our city, we originated over 50 some loans last year. And so you need those people to come back. You can't always be looking for the next client because that's very time consuming.
yeah. Okay, and how do you structure your private lenders? Is there a fund that they lend into? Is it per deal or how does
Yeah,
that?
I don't like funds. I think that funds, I've seen a lot of people make mistakes with funds, two ways. One is that if you don't have the money deployed, then it costs you. So you have to have the money in said bank account. So you're always actively deploying the money. And I think that causes mistakes. I think people get into deals they should not necessarily get into because they have the pressure of deploying the money. And so I never liked the fund. I also have different buckets of money that wouldn't qualify for a fund. Like my IRAs or my kids' Coverdales, the education savings
Mhm.
accounts, or my HSA. Like those things cannot go into a fund. They have to be done outside. And so I just do one person on one deal, making one loan to one house, and that's it. And that's worked out. It creates a little bit of a whack-a-mole situation that requires some administrative oversight. But yeah, I've just never been a big fan of funds.
Yeah, I mean, I've always done one lender, one deal. I don't
Yeah.
have an attraction to funds either, but
Yeah.
it's interesting. The people I've talked to who do have funds, they went that route because they were doing a lot of deals and they said it was simpler and gave them more flexibility in how they dispersed the money and what they used it for. So it's interesting that you're saying pretty much the same thing for not having a fund, that it's simpler,
Yes.
one lender to one deal, and it gives you more flexibility in including other accounts and things that
Yes.
complicated by the fund. So that's pretty sharp.
And I got very lucky in my career. I met some people who are really into self-directed IRAs. And I say IRA, but I always mean Roth when I say IRA. But and so I I have Roth IRA accounts. My kids have Roth IRA accounts. My wife has Roth IRA accounts. We all have Coverdale. Well, I don't have a Coverdale. All my kids have Coverdales. We have HSA. So we have all these entities and you can only move one of those entities at a time. You know, the IRS isn't real fond of you combining those entities together, and it's created these different buckets. And so I'm often, so it is an administrative issue, but I have no complaints, and I'm thrilled that a fair amount of my wealth is in a tax-free environment.
Yeah, for sure.
Yeah.
Okay, so let's look at if you were to restart your business, right? It was 2010 over again. Would you go the lending route, knowing what you know today, or would you still focus on the investing to build wealth and the lending? Because a 30% return is, I mean, that's pretty hard to beat,
It
right?
is. It
Yeah.
is. The only thing that will beat it would be like the infinite return on a burr of you go and you create 30 or $40,000 worth of equity on day one. Now, every day after that, your rate of return drops because the equity increases and your rent doesn't increase a lot. And so the return on the wealth has a lifespan, I believe. But no, I think that, and I was lending from the beginning on small dollar stuff, but no, I think the path of I'm going to own a bunch of rentals to create the wealth to now lend it was an important part of the process. Now, I created that wealth through real estate investing, but you could equally create that wealth. You could inherit that wealth. You could get it from a W-2 and just be very financially responsible. You could own another business, but I think that if you're going to lend a lot, you have to have a money to start with because otherwise you're just lending someone else's money. So whatever your methodology is for creating the wealth, I think that that helps if you're going to try to run a big lending business.
Yeah. Well, and I think, it's one thing to raise money on deals that you're actively involved in, and then the lenders are lending to you based on your character as well as the deal. But if you're just trying to raise money and re-lend it out to some other investor, I think that's a harder task early on if you don't have the experience. You have the experience of all the deals you've done, and people have been lending to you for years and seeing those paychecks come back to them. Uh,
Yeah,
so that's much easier.
it
So,
is. It's an easier sell. And another sell though that I do now that I think is significant is I take a first loss position in all my loans. And so in the same scenario where we're each putting $100,000 in, the way the note is written is the private money lender gets their money first, and then I get my money. And so that means if there's a loss, I take 100% of the loss. And so I underwrite the deals at 70%. I require an additional 10%. So the loan to value going in is at 60%. And then I have a first loss position for the other 30%. And so that means that the property value would have to decrease by 70% before the private money lender loses a nickel. And of course, other
Right.
than a fire, it's hard to lose 70% of the value of a home.
Yeah. Yeah. Sure.
And so that is attractive to the private money lenders. They're like, wow, I can't get 30% loan to value at the market earning a double digit return. That doesn't exist. And so it ends up being a pretty good product for them.
Yeah. It's I don't know. I like hearing your story. It's interesting for me because when I started buying rentals, yeah, I was doing the burst strategy and the returns were amazing.
Hmm.
I never thought that much about it because I was just rolling into the next deal. Well, it's just been probably the last year where I've been looking at, return on equity and what's the
Hmm.
portfolio actually performing at today. And that's a little more humbling. I liked looking at each new deal. The numbers looked a lot better. So,
Well, I'm
so,
sure that overall number looks like a really good number,
oh yeah,
but
yeah, yeah. It hasn't worked out poorly for me by any chance. But looking at, I never knew that hindsight, of once you build a portfolio with equity, your return does drastically drop.
it does.
So, so it's
And you have to
interesting. It,
you have to redeploy it. Yeah, you have to
yeah,
redeploy it. And you either do that by buying more burrs or take the choice that I did, which was I'm gonna turn it into paper. And by paper, I mean like a promissory note, a mortgage.
yeah,
And I had my one of those networking, another one of those networking events. I had an older gentleman. His name is Keith, and he's still a very good friend. And he told me that I would end up in paper. And I'm like, what do you like? I don't even know what paper is. What are you talking about? Because I was so proud of myself. I owned all these rentals. I thought I was the be all end all. And he just kind of chuckled at me and he said, I don't own any rentals. I'm like, how can you not own any rentals? You don't know what you're doing. And such a young kid. And he just kind of smiled. He said, you'll end up in paper one day. And so now he reaches out to me every once in a while just to give me grief about now I'm in paper. And
I told
the
you
gray
so.
hairs are correct. And the gray hairs
Yeah.
are correct.
So,
So
I mean, a lot of people that I talk to, and especially, I speak at different investor group meetings, and a lot of the younger investors or newer investors, one of the two, they're wrestling with how to find deals and fund deals.
yeah.
But a lot of the more experienced investors, they have built up some kind of equity or have cash sat on the side and they want to figure out how to lend it. So are there like key metrics to look for or things that they should if are there like three things they could focus on if they're looking to start lending money?
Yeah, so I think there's really only five things that you need to do.
Okay.
Number one is the underwriting. You have to underwrite the deal, right? You have to go 70% minus repairs, and you have to, you have to know how much you can sell it for and how much it's going to cost to repair it. So that's number one. Number two is insurance. You should have two different types of insurance. You should have one is the liability insurance for the person flipping the property, naming yourself as the mortgagee and the loss payee. And the other insurance that you need a mortgage title insurance because when you get title insurance, you only get insured up to the amount for which you purchased the home. But when you're lending, you're often lending on the purchase and the renovations, and so you need a separate title policy for that. The third thing that you need to do is they need to have skin in the game. Nobody, I don't care how many times you've borrowed money from me, I don't care how wealthy you are, um, you have to have skin in the game to move forward with the project on me. I require 10% of the project. Number four is reverse draws, is what I call them, where if you lend draw money, which I do, and I think it's a great way to do it, you're going to make them do the work on the property and then you give them the draw, right? So you don't allow them to, hey, put the deposit for the HVAC or like that
Right.
stuff is no good. Like you go, it's attached to the property and that's it. And the fifth one is simple. It's the paperwork and just making sure that you're in first position. If you've never lent before, you will at first be inundated with people who want you to go into second position. I encourage you to not do that until you are a very experienced investor, because you certainly do have more risk there. But yeah, I mean, the rules are fairly simple. We see banks all the time making loans, and I kind of think banks are incompetent. And if they can do it at massive scale, then we, as boots on the ground, should be able to do it fairly simply. And everybody wants money. Everybody wants it's a commodity. And any room you walk into in the world and say, who wants money? Every single person raises their hand. Now, I mean, might not want to give it to all those people, but it's a good commodity.
Yeah, yeah. It's well, and I'm a big one on I want my business to serve people, right?
Yeah.
I'm serving the lenders that I raise money for because they're looking for an investment like what I offer, and I'm serving my contractors, providing them work, and residents who live in a good house and have good management to deal with. And I feel like it's the same that your borrowers, when you're a lender, you are really serving them because that's one of the two big struggles for real estate is
Yep.
funding deals, right? Especially in purchasing a rehab that needs a lot of work and probably doesn't qualify for a lot of traditional financing anyway. So I think that's a great market niche where you really can help people.
You are quite literally helping people build their dreams. And people did that for me in my career. When I was borrowing money and I was creating my wealth, I'm very grateful to those people who were giving me that money. Without them, I I wouldn't be here. I wouldn't have had the opportunity. So the people that you lend to, they become your friends. They are very grateful. They're very loyal because you quite literally you change their life and their kids' lives, and it can be very impactful.
Yeah, awesome. Is there a minimum amount you would think somebody should have before they start lending?
I would think the number's probably around 50,000. If you want to be in first position, then you have to have enough money gathered to be able to be in first position. And $50,000 itself is not normally enough to be in first position, but you can combine it with other private money lenders to gain the necessary amount of money and then lend it. Um, but so it's probably around that
So,
number.
so if you were doing fractional lending, like you structure your deals, and you have $50,000 and you're doing it where you're putting in 25% of the money, then your first loan is going to be
Yep.
$200,000.
Yep.
And you're going to lend that out. And when you get it back, you're going to lend it out again.
That's right.
And maybe you have 30% of the loan that time, or
Yes.
yeah. Okay.
And and you're making on that scenario where you're making um, where you're putting in 50 and someone else is putting in 150, your return is around 50%. So you're making 50% return on that money. And if you're doing it in like an IRA that's not taxable, you really just compound that money and it grows very fast. And it only takes a couple years. I think the number is at 30%, 100,000 grows to like $1.7 million in a decade. And so if you're 50 and you've only got $100,000 and you're like, I need to retire in a decade, well, you can lend it at even 30%. So in 50%, it's even a much larger number. You get there much quicker. So it is
Interesting.
definitely a wealth builder.
Right. And the 50% is easily doable if
Yeah.
you're not trying to do a lot of deals, right?
Yeah.
In your
That's
story, the reason you dropped down to 30 and putting more of your money in each deal was just a factor of deal flow.
that's exactly right. And lifestyle. We originated 50 last year and we're earning 30% on that. If I wanted to earn 50% on my money, I would have had to originate 100 deals. And so the business would literally have to double. And so anyway, so we settled in on 30 and we'll probably be there for a bunch of years.
Sure. Man, I'm going to be honest with you. I have all kinds of ideas rolling around through my head.
Good. Excellent. Most
So,
excellent. I love it.
Yeah, I'm probably going to be reaching out with you to you with a couple questions here down the road. So,
Absolutely. I love to help people with that. It was an aha moment for me. And I really do feel like I got lucky so many times in life. Just meet the right person at the right time. And it almost always by happenstance. And if you're open to listening to it, you can just take something from people. And I feel obligated and obliged to try to do that to other people.
well, I appreciate it. I appreciate you coming on and sharing it. I feel like it's one thing that I've seen other people that I know do where they build up net worth in real estate and transition to lending, but I don't know that I ever fully understood why. Right. So I really enjoyed hearing your thought process, why you did it, and it overlaps with my whole issue that I've been going through of how to get that return on equity. So
Yeah.
it's very timely. So I'm glad we had this discussion.
It's tough to sell those rentals at first. They're your babies, right? You remember the
Oh
stories of
yeah,
how you got it. And, you know,
yeah,
you- I think people mistakenly say, "Oh, I wish that I had never sold all my properties." And that used to be what I would say. I'm going to keep them forever.
yep.
And then you realize they're really not making you a great return. And you got to let them go. You got to let someone else make their dreams with them.
It's interesting when I started in real estate, I never thought that I would have significance wrapped up in the number of houses I owned, right? I was just trying to pay the bills. That's why I
Yeah.
got in.
Yeah.
So wanted the kids to be able to eat, those little things.
They like to do that.
Yeah, they do like to do that. Yeah, fairly regularly. And
Roof over their head.
so now I'm surprised on the selling side that it is hard to let go, and there
It
is
is.
significance tied up in I own this many doors, and
Yes.
I've done this, and yeah, it's an
I used to
interesting
be, yeah, I
position.
used to be so I have this many doors, and that was part of my self accomplishment. Like it just, but you get older and I've matured and yeah, it was a process to let them go. And even some of them today, I'm selling three or four this spring, and I just remember all the stories. I'm like, oh, I remember when I bought this, and
Yeah,
but you can't stay everywhere. It can't stay in the same place for life for too long. So it's been good. It's been healthy.
yeah, sure. All right. Well, once again, I appreciate you coming on, sharing your story and insights. If anybody wants to find out more about you or keep up with what you're doing, what's the best way for them to do that?
Yeah, I appreciate that. I have a podcast. That podcast is Growing the Money, and I talk about my journey of growing the money and the things that I think that are important to that. Um, you can obviously find that in Apple Store and Spotify. You can reach out to me directly from my website, which is just richlennon.com. You can, the Smarter Wealth Blueprint is pretty long document that explains what I do with lending. And if you don't ever want to talk to me, but just want to know what I've been doing, you can go grab that. And if you're interested, like you can schedule a call from that website, a 30-minute call where I'll talk to you about lending and I'm happy to do that.
Sure. Well, everybody, I really hope you look into Rich's um, podcast site, what he has to offer. I mean, he's a very giving person and wants to help. And I know it'll be beneficial for you. Rich, thank you again for coming on.
Thank you, Chad. Thank you.
Enjoyed
I
the
appreciate it.
discussion.
I did
So,
too.
and for
Lived
all
it.
the listeners, always appreciate having you. Look forward to seeing you next week for another episode. And until then, keep building your dream life one door at a time. We are adding new episodes every week, so make sure and subscribe and check out all of our content at truewealthinvestors.com.